Hey everyone, and welcome to The Explainer. Today, we are going beyond the bank. We're going to tackle a quiet crisis that's hitting pretty much anyone with a savings account. The fact that your money is slowly but surely losing its power. So in this deep dive, we're going to figure out exactly why traditional saving isn't working anymore and explore a really powerful and accessible alternative for growing your wealth in this crazy low-interest world.
You know, a few years back, the Wall Street Journal published this one sentence. It's so simple, but it's absolutely devastating. What was happening? Well, the Federal Reserve had just announced it was going to keep interest rates at rock bottom for the next 2 years. Now, if you had a loan, this was great news. But for anybody trying to, save money, it was the exact opposite. It was basically a giant blinking sign that the old rules of money just don't apply anymore.
Okay, so let's just look at the brutal math here, because this is where it gets real. On the left, you've got the average savings rate, which sources put as low as 1/100%. That is basically nothing. It's a rounding error. Then, on the right, you have inflation, which has been hovering around 3.6%. That gap between the two, that's the whole problem. It means for every single dollar you have just sitting in a typical savings account, it's actually buying less and less year after year. Your money isn't just standing still, it's going backwards.
So, here's our game plan for this explainer. First, we're going to really dig into the saver's dilemma. Then, we're going to pop the hood and see what's going on in behind the low rates. After that, we pivot to the good stuff, the solution, with the investor's alternative. And don't worry, I'll walk you through the practical steps in opening your first account. We'll even learn some new lingo in a world of new assets before we wrap it all up at your financial crossroads.
All right, let's dive right into our first section, the saver's dilemma. Or, as I like to call it, the painful truth about what's happening to your cash in today's financial system. Just look at these numbers for the so-called safe places to put your money. Savings accounts, you're lucky to get less than 1%. Certificates of deposit, CDs, they've tanked to as low as 0.42%. And money market funds, get this, 1/100%. I mean, if you remember your parents or grandparents talking about getting 7% on a simple savings account, you can see we're in a totally different world. Safe has basically become another word for guaranteed to lose purchasing power.
So you got to ask why, right? Why are the returns just so incredibly low? Well, that brings us right to section 2, behind the low rates. We're going to uncover the real mechanics of why your bank pays you practically nothing for your hard-earned savings.
The whole story really starts here, with central banks. So in the US, we're talking about the Federal Reserve. But this isn't just a US thing, not at all. The same basic idea applies all over the world, whether it's the Bank of Japan or the European Central Bank. These institutions are the ones who set the big benchmark interest rates for the whole economy. And when they decide to set those rates near zero to get people to borrow and spend, well, that puts a cap on everything. Your local banks simply can't offer you a high rate when their own cost of borrowing is dictated by these rock-bottom policies.
Okay, get ready for this, because this is a concept that flips everything you probably think you know about your bank. When you put your money, let's say 100 grand, into a savings account, that's an asset for you, right? It's on your side of the ledger. But on the bank's books, it's a liability. It's money they owe back to you whenever you want it. And that's a really, really crucial difference for understanding what happens next.
So if your money is just a liability to them, how do they make any money? Well, they do it with a business model that's as old as banking itself. Borrow short, lend long. It's their secret sauce. They borrow your money on a short-term basis, because you can ask for it back anytime, and they pay you a teeny tiny rate for that privilege. Then, they immediately turn around and lend that same money out for the long term, and that's their real business.
And this slide just lays it all out. It's a simple and, for them, brilliant model. Step 1, you deposit $100,000. Step 2, the bank pays you a super low interest rate, and we're being generous here saying 1%. Step 3, they lend your money, your exact same money, out as a 30-year mortgage at 5%. See that 4% difference between what they pay you and what they charge someone else? That is their profit, made using your cash.
Okay, enough of the bad news, right? We've diagnosed the problem, we get the system behind it. Now, let's finally talk about the solution. And this brings us to section 3. The investor's alternative. And listen, this isn't just about picking a different product, it's about a total shift in your mindset, from just passively saving to actively growing your money.
This slide really lays out the two different ways of thinking. The saver's main goal is just to store money safely, but their biggest risk, the one they don't always see, is that silent killer, inflation. Now, the investor's goal is to actually grow their money, and their biggest risk? That's market volatility, the ups and downs of prices. But here's the critical difference. Inflation is pretty much a guarantee over time, while volatility is a risk you can actually understand, plan for, and manage.
This quote really captures the investor mindset perfectly. It's based on a strategy that experts like Warren Buffett have used for decades. The basic idea is, instead of just buying a stock, you can sell a contract. It's called an option that gives someone else the right to sell you that stock at a price you already decided you'd be happy to pay. And just for taking on that obligation, you get paid a fee, called a premium, right up front. I mean, the source material gives an example of earning 2.4% in a single month doing this. You see the difference? You're no longer just sitting on the sidelines. You're actively getting paid for your strategy.
So this is the big takeaway. In the world we live in now, saving is your anchor. It's for your emergency fund, it's for stability. But it is not going to move you forward financially. Investing. Investing is the rocket. It's the engine for building real wealth that actually beats inflation by putting your money to work in things that have the potential to grow.
Now, I know this all sounds great in theory, but you're probably thinking, how do I actually do any of this? Well, that's what Section 4 is all about, opening your first account. We're going to break this whole process down into really clear, totally unintimidating, and actionable steps.
Here it is, the entire process from start to finish. It's a really simple 4-step roadmap. First, you choose a brokerage firm. Second, you pick their trading platform. Third, and listen, this is a step you absolutely cannot skip. You practice with what's called a paper account, which uses fake money. And finally, only when you feel confident and ready, you fund a live account and get started for real.
Okay, so let's break down those first 2 steps a bit. When you're choosing a brokerage, you've basically got 2 flavors. Full-service brokerages are kind of like having a guide. They offer more support, more advice, but they do come with higher fees. Discount brokerages are more of a do-it-yourself thing, with much, much lower fees. Then you pick your platform. A web-based one means you can log in from pretty much any internet browser anywhere. A client application is software you actually download to your computer. It really just depends on your budget and what you're comfortable with.
And here is some really good news. This opportunity is not just for people living in the United States. The source material is super clear about this. The US market is the biggest and most active in the world, and it's incredibly accessible. People from Germany, Singapore, Australia, the UK, Japan, even Paraguay, they all regularly open accounts with US brokerages to invest. So you are not limited by where you live.
Now let's talk about practice versus the real deal. A paper trading account is your flight simulator. It is your best friend when you're starting out. You get to trade with a bunch of fake money, maybe $100 grand, and you learn the platform and test out your ideas with absolutely zero risk. Once you're feeling good about it, then you open a live account. And you don't need a fortune to start. The sources point out that minimum deposits can be as low as $500, with maybe $2,000 being a more common starting point. You start with what you have.
So once that account is open, you're going to start seeing a bunch of new words and new ideas. Section 5 is just a quick primer on this world of new assets. Think of it like learning the basic lingo of investing.
So let's just quickly touch on the main things you'll see. Stocks are probably the most common. That's just owning a tiny piece of a public company, like Apple or Google. Options are a bit more advanced. They're contracts that give you the right to buy or sell a stock at a certain price. They're tools you can use to generate income or manage risk. And then, of course, you've got modern digital assets like cryptocurrencies. Look, each one of these is its own world and requires research, but they are all tools that become available to you once you step beyond the bank.
Wow, we have covered a ton of ground, from the broken promise of a savings account all the way to the practical steps of becoming an investor. And that brings us to our final section, and really a pivotal moment, your financial crossroads. Because at the end of the day, the choice is yours.
This source material gives us this really powerful analogy for this choice. Think of the entire financial system as the Titanic. Now, you as an individual, you can't control systemic risk. You can't steer the ship away from hitting an iceberg, like a global recession. You have no control over that. But what you absolutely can control is whether you have a plan to get off the ship. You can control whether you have a lifeboat.
And that right there is the final crucial point. The real tragedy of the Titanic wasn't just the iceberg. It was the shocking lack of lifeboats. It was the lack of an exit strategy. And in today's financial world, just passively saving your money, that's like staying in your cabin and just hoping the ship doesn't sink. Investing is about taking personal responsibility for building your own lifeboat. So the question I want to leave you with is this: what's your plan to get off the ship?